Do we have Chiara on?
There we go. Wouldn't let me unmute.
Oh,
I'm
okay.
Chiara Portner. I'm a shareholder at Hopkins Carley. I'm the head of the IP and privacy group. Our firm has been around for a number of years in the Valley, and we support startups and large companies throughout their whole life cycle. We provide formation, advice on financings, M&A, IP, privacy, tech licensing, employment, real estate, tax, etc. Everything that a startup would need in this area. So as firm attorneys, what we do is we really try to partner with our clients and understand their business and their operations in detail. And we streamline our staffing on clients to have primarily more senior attorneys, and a lot of us are formerly big law attorneys. So we have lower hourly rates than a lot of the more junior attorneys at big law firms. We've been partnering with SV Forum for the past year. It's been great. And so I hope you enjoyed the program.
Thanks so much, Chiara. All right, so I think we're going to turn it over now. We're ready to bring on our guest speaker, Gareth Kane. Gareth, you want to just kick it off by first, telling us a little bit about yourself and maybe a little bit about your venture fund as well?
Sure. Thank you, Denyse. Hopefully you guys can hear me. I'd like to thank Denyse and the organizers for including us. We're really excited to be part of this event. I'm a big fan of what Silicon Valley Forum does in terms of just fostering and growing the entrepreneurship ecosystem in the Valley and worldwide. So quick overview, just to kick things off, of Promus Ventures. We are a very active seed and early stage venture capital investor. We have a team based both in the US and in Europe, and we really look to fund what we feel are exceptional entrepreneurs and teams who are working on solving really hard problems, often using what people sometimes call deep tech or frontier technology. We've been around since 2012 when our first fund was raised. And our investment thesis is fundamentally around investing in companies at that intersection point between enterprise-driven data and then tools like machine learning and artificial intelligence that extract value from that data. Often, we're funding companies that are generating value for enterprises in really large sectors of the global economy that have historically been slower than others to adapt technology. Think about areas like construction, resource extraction, transportation and logistics, manufacturing, agriculture. Solving really fundamental hard problems with tech is kind of what we like to see people do. We're currently well over 80 companies in our portfolio, actually closer to 90, I think. Investments across the United States, Europe, and Australia and New Zealand. And we have an active portfolio of about 50 startups, which we work with. We're happy to lead rounds. We're also a very good syndicate partner with other investors. And for us, we kind of have a third general fund being deployed right now. And we've recently just had a final close on a new sector-specific fund. I know we have a bunch of European entrepreneurs on the call. So we actually have this fund running out of Luxembourg. We have a small team of investors working out of Luxembourg now that will concentrate on funding globally, but with an emphasis on companies in Europe. And this fund in Luxembourg is, again, very deep tech focused with a particular exposure to the new space ecosystem. We've been an active investor in space in particular for the last 5 to 6 years. And I've seen some great successes in that sector. Some of them you might know. In fact, I know there's a bunch of attendees today from Austria. So one of our standout CEOs is actually Austrian, a guy called Peter Platzer, who we've worked with for close to 6 years. He recently took his company Spire public on the New York Stock Exchange through a SPAC transaction. So it's been really exciting to be part of that journey, and good to see very strong European entrepreneurs building really what are global businesses. So with that, I thought I would flip over to the term sheet discussion and give you guys a couple of sample term sheets that I've just generated using the kind of very standard document generators you can get from organizations like the NVCA, the National Venture Capital Association here in the United States, and also a set of documents that were generated through Cooley. Cooley is another Silicon Valley, well, not just Silicon Valley, but another sort of global law firm. we use them for a lot of our fund work, and we use them with a lot of the companies that we work with. So we're very familiar with what they do, and they again have a very standard sort of online template generator. So I've generated a sample term sheet for convertible debt and a sample term sheet for a seed equity financing round. And we'll step through those and talk about the terms and the ones that you should be sort of interested in and focused on. I think the very first thing to say for you is that I am not a lawyer. People like Chiara are your best friend when it comes to negotiating and working with an investor around a term sheet. They are the ones you should be happy to pay money for and getting feedback from, because they will guide you through some of the complexities and some of the, I guess, the pitfalls and the sort of hidden minefield that can sort of exist around some terms. It may be helpful to frame this, I think, as well, with just some thoughts around the venture capital sort of journey in general. Most of you, I'm sure, are interested in raising money from investors, and it's typically a marathon rather than a sprint. You sort of spend a lot of time getting to know the investors who invest in your sector or in your field or in companies like yours. And that whole sort of journey may be helpful to spend 2 to 3 minutes just sort of talking on to give you some context around how a term sheet actually arrives into your inbox. It's typically how it arrives these days. So, as an entrepreneur focused on building a company, you're going to be meeting a lot of other founders, meeting a lot of sort of potential junior investors at events and things like that. Your first challenge is obviously getting through the initial sort of screening with a venture firm and getting down that path towards getting a term sheet sent your way. And this is, it can take as long as it takes. For most entrepreneurs, it doesn't happen overnight. It is a journey of building relationships, of getting to know the firms that you're excited about and interested in, and getting to know the investor you're interested in working with, and then sort of building a relationship with them, and then eventually providing enough data points and sort of proof points through getting to know them that they become convinced that you and your team are solving an interesting problem and a high value problem that people are willing to pay for. And it's sort of like a funnel, right? An entrepreneur will typically talk to multiple investors, but as an investor, I talk to probably an order of magnitude more opportunities every year. I think a firm like ours probably sees 2,000 to 3,000 investment opportunities, and we maybe fund 15 to 20. So it's a pretty aggressive winnowing from a very wide top of the funnel down to the opportunities that we actually do decide to issue a term sheet to and invest in. So getting through that funnel is really a slog for many companies. And I guess one piece of advice and feedback is don't get discouraged by just how long the process takes. I think we all have this vision of sort of the Silicon Valley, alchemy and magic, where you go to a demo day or you go on a sort of a fact-finding trip like you're doing right now with the Austrian entrepreneurs to the Valley, and you meet an investor and he gives you a term sheet that day, and that can happen, but it's pretty atypical. For most entrepreneurs, it's a pretty long-term journey to get to the point of getting a term sheet from an investor. Many times people ask, what's the best way to get to the top of an investor's hit list and get them interested in you? I will say, given the number of opportunities that a typical investor sees in the Valley, getting a very friendly intro is probably the best way to get to the top of my inbox or the top of any of my peers' inboxes. Either an entrepreneur that we've worked with in the past or that we know well, or another investor who we have sort of a good relationship with. If they recommend a company to me or recommend that I meet a CEO, that will always typically get to the top of my to-do list. My to-do list tends to be pretty busy. So it's very easy for stuff that's not at that top to kind of fall off the bottom on a regular basis. So I think if you can, building relationships with entrepreneurs who you've kind of got to know and who have connections into the firms you want to work with, that's a great way to. Service providers like law firms can be very helpful as well. If you have a relationship with somebody like Chiara, who does have sort of strong relationships into venture investors in the Valley, that's again a great way to kind of get those initial conversations going. But then it tends to be almost a process of attrition. It's very rare that we would fund a company when we meet them for the first time. Often we want to see sort of milestones being hit. We want to get a sense of the traction. We want to get a sense of the execution of the team before we get to the point of being ready to issue a term sheet. So with that, I'm going to switch over and just share a couple of things. If I can share my screen. Here we go. So I'm going to start off with a term sheet for what's called convertible debt. Hopefully you can all see this. Let me know if you can't. This is just a very sort of simple 2-page term sheet, very similar to something you would get from an investor. And I think maybe sort of a quick primer here on really 2 forms of sort of financing from an early stage investor like us. We like to fund what's called an equity round, where we're actually buying shares in your company, but often as sort of an intermediate step between rounds, or as a very initial early form of financing, people will do what's called a convertible debt, or a sort of similar form, what's called a SAFE, a simple agreement for future equity, which is very popular with companies and accelerator programs like Y Combinator. They will use that as a way to sort of get money into a company early. And there are pros and cons to both. But really, convertible debt is a pretty easy funding mechanism to get your head around. So I thought we would start with that and just talk through some of the kind of key terms and sort of key elements of a convertible debt term sheet that you should be aware of as an entrepreneur and maybe focused on. And I think one big takeaway, as you think about term sheets, a term sheet is really the starting point for a negotiation, right? It's sort of the terms that you and your likely investor agree to. What happens then is that lawyers like Chiara, they kind of go and they take the term sheet, which sort of lays out the outline, and they generate the actual definitive documents for a transaction. So the documents which kind of flow out of a term sheet as you get towards a closing date are really much more complex and sort of expand on all these terms and have a bunch of boilerplate language that we're not going to get into. But a 2-page term sheet for an equity round or a convertible debt round may become a 50-page share purchase agreement, a 50-page investor rights agreement, a whole bunch of other documents around the financing, which are all driven by the terms in here. So, that journey and sort of that work from term sheet to get to the definitive docs, again, is handled by your counsel and by your investors' counsel. But it's just important to realize that a term sheet is really just the first step towards getting towards those definitive agreements around a financing. So, convertible debt term sheet. Actually, I'm going to take a quick pause here. I'm not keeping an eye on the comments on the chat, but if there are any questions, let's take a quick look there. No, I don't see anything. Great. Okay, good. Any questions before I do jump into the terms? Oh, I'll take that as a no. Okay, term sheet. Very, very simpler. The test company, what I put into my document generator last night as I got the sample term sheet ready, that really is just your entity, right? It's whatever your company is called. One thing to be aware of, especially if you're an international founder coming to the US trying to raise money, many value investors will be most comfortable investing in what's called a Delaware corporation. Various historical reasons for this. The main reason is that that's what they've always done. There's a very well-established body of corporate law around Delaware entities and a lot of sort of precedent from hundreds of years back, which is why the vast majority of sort of venture-backed companies are Delaware C Corps. If you're an international entity, it's not impossible for a Silicon Valley or a US-based VC to fund you. It just may be a little bit more complicated from a legal perspective. Many investors will ask you to set up a US entity. You either flip your existing entity into the US, or you set up a sub. And there are various structures. This is what lawyers are for. They'll help you think through all the complexity there. Investors typically defined legally in terms of who they are. There'll be some language here around closings, but really a convertible note is essentially a form of debt, which has a maturity, sort of a term when the note needs to be either repaid or converted. It will typically have an interest rate. There will be some term around future notes or other fundraising events and how these get treated in terms of seniority or sort of position in what's called the preference stack. One of the interesting things about debt is that debt can be senior or junior. So very often an investor will want to make sure that his debt is what's called pari passu, or sort of equivalent to any other debt that you raise as a company. So very often an investor will have a term in their term sheet requiring their approval for any other debt that you might issue as a founder. One interesting thing you often see is what's called a most favored nation clause. And this will appear in many sort of forms of legal docs, but you often see it in the term sheet, which essentially says that if you, as a founder, issue debt to somebody else, which is more preferential, maybe has a better interest rate, maybe has a more attractive conversion rate, or maybe gives a premium in the event of a transaction, that the holders of the rest of the debt with this MFN, this most favored nation clause, will automatically be entitled to receive the same terms. So that's one thing that they often will be in a debt term sheet. There'll typically be a term around qualified financing, what will count as essentially a trigger event for the debt to convert. Typically, there is a term around the conversion discount. A debt is typically, or a convertible note is typically, we like to see as an investor, both a valuation cap, so a maximum price that we will be investing into when the company eventually raises an equity funding, but we also would like to see a discount if we don't quite get to that cap. So these are all negotiable terms, but very standard in the Valley is like a 20% discount to whatever the next fundraise is at. The kind of valuation cap is very much a negotiation. As an investor, I obviously like to see this as low as possible. As an entrepreneur, from a sort of a dilution perspective, you obviously want your valuation to be as high as possible. That's always between you and your investor. Anything else in here? Like there's typically terms around change of control. Sometimes investors will look for a multiple on their investment from a convertible perspective. If there is a change of control transaction, if you as an entrepreneur sell your company before you raise an equity round, typically an investor might like to see 2 times their money or 3 times their money back. But again, this is a negotiated term. It's something you can work on. There's typically a term around prepayment. Typically, convertible debt is not secured by anything on the company side. It sits below every other debt. And this is kind of an interesting one, typically on the convertible side. The fact that the company and the investors bear their own legal expenses. As you see, as we look at sort of the draft seed equity financing doc that I put together, typically the entrepreneur and the company is on the hook for some of the financing transaction costs. I would encourage you to push back on this on the convertible side. It's typically a very easy document to put together. There shouldn't be a huge amount of cost from a legal perspective. I think it's totally fine for you as an entrepreneur to push back on the legal cost side. But really, I think on the convertible debt term sheet front, the 2 takeaways are, you should care about maturity and what your sort of obligations are. Do people automatically convert? How long you have before you have to do something about this debt. You should care about the interest rate, and you should care about sort of the valuation and the conversion discount that you're offering to the investor. But typically, the more attractive these are, the easier it is to get people to invest into a convertible debt round. If there are no questions on convertible debt, we'll move on to the much more interesting side, which is the equity side, which is, as you can imagine, a lot more complicated and a lot more terms that you need to be sort of aware of and focused on. But let me know if anybody wants to pipe up. I'll take a quick look at the chat and see if there are any questions in there. I see one about an either or from Linda for valuation cap and discount. So typically as an investor, I think you would like to see both. But everything in life is a negotiation. If you can negotiate one or the other, that's entirely up to you to try and float. I will say that, as an investor, I can always find a reason to say no to a deal. And I may regret it in the future, but no deal is ever perfect. And the more friction you introduce into the fundraising process, the harder it is to get your investors to commit. So that's just one thing to think about. Kathleen has asked, are there optimal terms for convertible debt? Not really. I mean, I think the 2 big levers to think about are valuation and discount. The sort of, higher you can push your valuation cap and the lower discount you can give your existing investors, the better. Those are really the 2 terms that I would sort of focus on. Somebody, Rakesh, has just asked, can you explain discount a bit further? Perhaps an example? Sure. So let's take a look at our number here. So in this particular term sheet, we talked about an 80% discount. So the way to think about that is if your next round of financing is a priced round, an equity-based round, and you're valued at, nice round number, let's say you're valued at $10 million pre-money. And just to explain how you think about pre-money, if it's an investor comes in and says, I think your company is worth $10 million. I want to invest $5 million. So, our final post-money valuation will be 15 million. My $5 million is worth 33% of the company, so I'll own 33% of the equity. The discount is to the pre-money price. So if I'm a note holder who's an investor in your company way early on, my pre-money is 80% of that $10 million. So my pre-money is 8 million. So I convert in at that sort of discounted rate ahead of time. Charles, is either cap or a discount. The next round of financing values that higher than the cap is basically the cap. Yep, that's right. If the valuation is lower, it's converted with the discounts. That's exactly it. So investors will typically want to have both, right? Sort of a maximum they will pay, and then a discount in case that cap is not hit. People will, I think Prashant has just asked, is the term sheet initiated by the investor or the entrepreneur? It can be initiated by both. One of the good things about convertible debt is that it's a pretty standard instrument. Something like this 2-page term sheet, you get that from me. It's also probably quite fine for an entrepreneur to put that out there. And in fact, what will often happen is that an initial note investor will agree to a note term, and then that same note term is shared with other people. So I may be raising, $2 million on a convertible note. Maybe my first investor does $1 million, and that same note term sheet is then used by everybody else to subscribe to that total $2 million. So it can often be done by the entrepreneur. It's not a very complicated thing to put a convertible debt term sheet together. Danuka has just asked, aside from the owner investor factors, is there anything else that influences valuation cap, such as existing investors? So I think this is where you would think about something like a most favored nation clause. Typically, in the ideal scenario, if you're raising multiple rounds of debt financing, convertible note financing, your valuation cap should be either staying constant or trending upwards. Now, one of the issues that you often see with a company that raises lots of money on valuation, on a consistent valuation. So say you raise, $1 million in one note at a $10 million cap, and then another $1 million in a note at a $10 million cap, and then another $1 million at a note at a $10 million cap over the course of maybe, a year or 2 years to keep your company going. By the time you actually get to the equity financing stage, you have quite a lot of overhang of existing debt that needs to convert into that round. And if you don't sort of hit the metrics and sort of get the traction numbers that maybe you need to justify a valuation that's at an interesting level, you can find that the dilution, which is driven by all those that sort of note overhang, can be pretty onerous. Does that kind of make sense? Hopefully that does. Existing investors on that sort of note side, they will, if they see you giving a lower valuation in a future note, this most favored nation state or question will come in. So it's sort of important to be aware that you can raise money indefinitely using convertible note structures, but it will eventually become quite onerous to make sure that unless you keep raising them at much higher caps going forward, and people do, but it can be sort of a complicated thing to manage if you don't eventually get to the equity financing piece. One of the good things about convertible debt is, it doesn't happen very often, but it does happen. Like if you decide you want to repay it, you can do. So if you have, a large influx of cash from somewhere and you want to get sort of a particular investor you maybe don't have a great relationship with, it's pretty unusual to see somebody repay a note and get an investor out of the company. Most of us are interested in converting. That's why we're giving you debt initially. But you do occasionally see somebody pay out a convertible note and get an investor off their sort of not quite on their cap table, but off their sort of capital structure. Okay, I've got one direct message from Preeti, which I'm going to take a quick look at here. Actually, I can't see that right now. Sorry. Good. Okay, so I think that's it on the convertible debt side, unless I missed anything. Okay, one question from Linda. If the company raises an equity round after several convertible notes, that equity doesn't dilute the notes, correct? Typically, no. Like convertible debt will convert into that equity round. And in fact, it will dilute the entrepreneur, typically. I mean, it's very unlikely that there will be sort of pushback from an investor to sort of, force a note to sort of, convert at a less favorable term that has been defined. Now, again, everything is up for negotiation, right? And I will tell you, I've sold a company to a company where we had a convertible note in, this is many years ago, a very large computer electronics company here in the Bay Area, who I'm not allowed to name for various reasons, but they pushed back very hard. We had a we had a multiple on exit. So our note would pay out in sort of a 2 to 3x in the event of an exit before an equity round. They pushed back quite hard. It was more of an acqui-hire situation. So they wanted to see more of the transaction go to the founding team. So they pushed back very hard on that and essentially said that if we didn't dial back to, I think it was 1.5x we got in the end, that they would not essentially do the transaction.
Gareth, I have a question
Sure, go
for
ahead.
you. That's something that I have found with companies coming from abroad. Sometimes they tend to have a higher valuation than we're typically used to in the Valley. And so is there an opportunity to use a note for down rounds or down valuations? Because that sort of messes their cap table.
Yeah, it's a good question. And that's kind of becomes very messy. That's where a lawyer is probably your best source of sort of counsel here. I mean, you can essentially structure a transaction any way that both parties agree to. So you can certainly have that conversation. I would imagine that would be challenging. And it would certainly make me kind of think about a deal very carefully. I mean, why would you not just do an equity down round? I just don't know why I would sort of do a convertible note. And it's interesting you say that companies coming from overseas with higher valuations in the Valley, that would be atypical in my experience. Companies in the Valley are very,
I'm
very
thinking
highly
about,
valued.
right. I'm thinking about the ones that come from Asia in particular. I've seen quite a few.
Got you. Yeah, potentially something coming out of the Chinese ecosystem could be super, super highly valued. That is fair. Red Milo just asked about interest being subsumed by a discount in case of conversion. Typically not. Typically the sort of interest is added to the principal, and then that entire amount is then discounted if you're not at your valuation cap. So that's kind of typically the way it goes. Somebody asking about a CAFE, a CAFE, a continuous agreement for future equity. So it's kind of I haven't seen one of these personally, but I'm aware of the structure. It's essentially sort of an ongoing safe, and people do tend to raise multiple rounds of financing on a safe note. What we typically see though, particularly from YC companies, is Y Combinator companies, is the safes tend to incrementally increase in their valuation cap. So I think a rolling safe, one of these sort of fixed valuation points, again, you would run, I would imagine, into the same problem with a valuation overhang, where if you keep raising money on a safe that eventually converts into equity, if you have a lot of money sitting on that safe, there will be, unless you hit a very interesting valuation point from an equity round sometime in the future, then there's probably going to be an overhang from the point of view of that conversion that will mean dilution for you as an entrepreneur. So I think, as long as your value of your company keeps going up and you keep hitting your milestones, all these things are kind of theoretical problems. It's the downside scenario that really your lawyer helps you think about, where things aren't going so well. Rajesh has asked, could there be a group of investors for a note round? And typically, yes, Rajesh, you often see many investors subscribing to a note term sheet. It's kind of often the classic Silicon Valley or other angel syndicates where people are contributing maybe 50K, 100K, 200K to a note, and you're raising $1 million to $2 million. You can see an individual venture investor do a note completely themselves. So we often have done that where typically it's between maybe a financing round just closed and we missed it, and we are willing and want to put money in right now just to have a position for the next round. Maybe it was too early for us, but we want to position ourselves for the next round. We will often be very open to doing a note, which is either at a sort of slightly step up from a cap perspective or at a discount to whatever the next round is priced, just to allow us to have a seat at the table. Anita just asked about valuation overhang. Anita, this is the problem where, not a problem, it's a scenario where you, as an entrepreneur, raise lots of money on notes. And when you eventually get to convert those notes, unless your valuation is sort of high enough to support that conversion without significant dilution, if you have a company that's valued at $10 million pre, but you have $5 million in notes that need to convert in there, that also needs to convert into your $10 million pre money. So you're actually $5 million pre. So you're getting pretty significantly diluted by the investor sort of notes, which are sort of overhanging any equity transaction. Good. Okay, I think that is all the questions. I may have missed a couple, so hopefully somebody's capturing those. There's been a lot flying by on the chat. I'm going to move on to the equity term sheet because that's actually a lot more interesting. And if we spend 30 minutes talking about debt, we're going to be out of time pretty quickly on the equity side. So let's put this up here. Okay, so this is again, generated out of a pretty simple set of terms, just one of these online sort of term sheet generators. And it is for a company where you're issuing sort of seed shares. Typically, you talk about sort of the proceeds the company is going to get. You know, the investor will typically have some control over who's allowed to invest. The lead investor will typically have some control over who's allowed to invest. There'll be a price per share defined. There will be, this is an important term, what's called a liquidation preference. Very often, cap tables and capitalization structures are thought of as a sort of debt, preferred shares, and then common stock. And typically as an investor, I like to own preferred stock. And that's important for me as an investor because it means that when there is a transaction, an exit of some kind, whether the company gets sold to an acquirer or the company goes public on one of the public exchanges, the preferred stock sits on, well, it sits under debt, but sits on top of the stock sort of payout. So if I'm a preferred stock owner, I get money before the common stock owners. That's kind of important to me as an investor. So typically, an investor will have a preferred share in certain markets and certain times. Right now, it's a pretty entrepreneur-friendly environment in the Valley and really globally from an entrepreneurship perspective. So you don't typically see more onerous terms than just simply a preferred stock. But often in sort of more punitive scenarios, like a down round would typically maybe have a higher liquidation preference. And this is where an investor will ask for 2 times their preference. So if I invest $1 million, I want to see 2x out in any exit event. There may be a term you don't see it in this term sheet, but you may see it occasionally, and your lawyer will help you sort of push back on this. But it may be what's called a participating preferred, where essentially as an investor, I get to double dip. So I get to sort of pull my money out and then get to also pull money out on the common side as anything that flows down that way. Voting rights, another very important term to be, I think 2 takeaways from sort of the equity financing term sheet that you should really be focused on are valuation and dilution as an entrepreneur, and then control. And there's a number of terms that kind of go into the control side, which are typically things like voting rights and whether, you know, any decision is sort of a combined majority vote if the different stock classes, you know, cede on the preferred here. But as you do future raises on the equity side, you may have, you know, a Series A class of stock, you may have a Series B class of stock, you may have a Series C class of stock. And often investors will ask for, you know, every class of stock to independently approve a transaction. It will be the preferred voting combined versus the common voting combined. So all of these voting right questions are very important to sort of work through with your legal counsel. Typically, there'll be a term around sort of major investor rights, and you'll often find, especially if you're having a syndicated round, there will be a cutoff point where you want to say limit the information and access to who are truly your major investors. Like if you're a CEO, you know, really your job should be focused on building your company and making it successful. And if you have, you know, multiple investors who contributed small amounts of money asking you for things continuously, that can be pretty annoying, having been on that side of the table once upon a time. So very often there'll be a sort of a major investor sort of threshold that you should sort of stick to your guns on. Participation right, again, very important for investors. This is my ability as an investor to participate with what's called my pro rata in future rounds. So if I invest and own 10% of you in your seed financing, like we're talking about here, I typically as an investor will want to make sure I have the right, but not the obligation to buy 10% of your preferred equity in all future rounds. And I may decide to give up that right and not do my pro rata, but you often will find investors asking very, very sort of pointed questions here about ensuring they have pro rata rights. And in fact, you often, back to our convertible note term sheet, it's not unusual and not unheard of for an investor to sort of put something around the convertible to make sure they have the right to buy equity in sort of the future round to get the ownership they want. Board of directors will typically be a pretty important thing for you to think about. This comes back to the control question for your company, of you as an entrepreneur. Very important that you keep I feel as an entrepreneur, you should run your company, but not all investors feel the same way. So being focused on things like valuation and how much of the pie you own is important, but in some ways I would put control as even more important for you as an entrepreneur. You want to be in control of your own destiny, and like the worst possible thing from a founder perspective is when your investor decides to move you out, and they can do if they control the board. So, making sure, especially at the early stage, that you keep the majority of the board votes on your side, I think is sort of one thing to be willing to compromise on other terms if you need to retain that control. It becomes less important over time, and as you get more voices around the table, the investors will typically outweigh the founder and sort of the founding team from a board perspective. But certainly early on, we are very comfortable, and any good investor should be comfortable with you guys having control as an entrepreneur. Here's the expenses thing. I don't know why, but investors always like to see the company carry the burden for transaction documents. I would sort of push this as low as you can. Really, it's not that meaningful, but I think it's a show of good faith from your investors if they're not putting like big numbers in here and expecting you to sort of carry the burden for expensive sort of legal teams on their side. Typically, your preferred equity investor will look for their rights to continue into the next series of preferred stock, and it kind of comes down to this most favored nation station again. There will often be desire from your current equity investors to be treated equally and fairly with future investors in the future. The good news is that, like everything, this is always a negotiation, and very often a strong lead investor coming into the next equity funding will push back on anything they see as egregious. I guess one other sort of interesting thing that may well come up in the term sheet is around founder equity vesting. Typically, an investor will like to see, maybe your company is 2, 3, 4 years into its journey, and your sort of incorporation documents and your founder vesting may be already 100% vested. Very often, an investor will want to see some kind of handcuff to keep you as the founder sort of focused on the company. So they may reset or ask to reset some percentage of your equity to vest again to keep you focused. I think there's ways that you can work around this, and obviously if you're familiar with the term double trigger, this is sort of a way for you to make sure that if there is a transaction or some kind of exit event ahead of your vesting schedule, that you do get sort of the full value of your equity. It will all sort of instantly accelerate and sort of vest for you. And then I think the final sort of one to be aware of is this idea of binding terms, right? Typically, when an investor issues a term sheet, they like it to be binding, sort of exclusive, kind of what people call a no shop clause. So as you're thinking about the term sheet process and getting to this, this is obviously a major milestone to get to with any investor, but ideally you'll want to have a process running where independently you have conversations going with multiple investors and you receive multiple term sheets, because that drives all the interesting levers like valuation and control. It's just simple economics, supply and demand. If there are multiple investors interested in funding your company, your ability to drive towards optimal terms for you is much higher than if it's just a one term sheet. So typically an investor will put a term into their term sheet saying that you can't use this term sheet to go and get other term sheets. Now it's totally fine as an entrepreneur to tell investors that you have a term sheet from somebody else, but sharing those terms is definitely not something that you should be doing, just from a good faith perspective. It's totally okay to say you have one. Hopefully you do have one. I wouldn't encourage you to sort of tell fibs about this. I think one thing to realize is that certainly Silicon Valley is very highly networked, and I will often be looking at exactly the same companies as my peers in other investment firms, and we often talk about you guys. We talk about sort of interesting companies that we've seen. We sort of share feedback on areas and sectors and entrepreneurs that we're tracking. And if an entrepreneur tells me he has a term sheet from one of my peers, I can usually, from asking them if they're given a term sheet to a company, and if they tell me no, I'm like, okay, well, that's not true. So that kind of is a bad sign for me. So I think it's back to this question of sort of information sharing. The no shop clause is important for you as an entrepreneur. I think it's totally okay to verbally describe to other investors that there's exciting things happening, and it's actually good for you to do that because it drives good behavior on the investor side. But you have to be careful. And again, your legal counsel will give you all kinds of good feedback here about what's okay and what's not okay. So that's a very simple equity term sheet, typically then signed by sort of the CEO and the lead investor. So I thought as a final sort of piece of the puzzle, I would show you a, question from Rakesh about agreeing to binding terms. No, from a founder standpoint, well, eventually, you do come to an agreement around a term sheet, and those are sort of I think this binding term clause will be in any term sheet that we issue. So if you sign our term sheet, you're essentially agreeing to this no shop sort of clause. I mean, if you don't sign a term sheet, I think it's okay to maybe okay to socialize it with other folks, but I think that's something you have to be very, very careful with. I think if people get the impression that you're essentially trying to, drive a bidding war between investors by sharing the terms you're getting from other investors, that can be very, 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 very challenging to navigate if that sort of perception gets sort of out into the investor community. Danuka just asked, what's the difference between participation and future rights? This is pretty standard. Like a pro rata right is not something you should be worried about giving up to somebody. I think that's again, it's negotiable. If somebody like SoftBank comes into your next round and they want to take the entire round and give you $100 million check and not leave any pro rata for your existing investors, that's kind of between me and SoftBank. That's not your problem. That's a great problem to have. So yeah, it's this will be something that I think every investor asks for on the participation side. Future rights, I think, is a bit more nebulous. It's kind of like a most favored nation clause again. Most investors will ask for it, but again, as the next round sort of unfolds from a dynamic and sort of a lead investor perspective, everything is typically up for negotiation over again. But let me show you guys what an actual sample real term sheet looks like. This is from a deal we did back in December. I've kind of taken out some of the context around who it is. So you can see, the no shop question in here. I mean, it's pretty important to us as investors. But really, the rest of it is not binding until the definitive docs get agreed. So you can see, it's not quite the same as this very sort of simple template we had a few minutes ago. But typically you have, amount raised, securities sold. I think we hadn't quite filled in the per share price because we had to work out some of the conversion on the existing notes. The board of directors gets defined. In this case, it was one of the common stockholders, one CEO designee, and then sort of us as the lead investor. Closing date is typically defined. Here's the whole no shop confidentiality clause, and then you often will see this from an investor. So essentially an expiration date, and people call this an exploding term sheet or something along those lines. And typically, you don't want it to be an open-ended process if you're an investor. You want to drive to some kind of deterministic close, and sometimes it will be the same week, sometimes it will be a couple of weeks. But typically, as an investor, we will ask for some kind of an expiration date where, if you don't accept our term sheet by that stage, we're under no obligation to move forward with the terms we've shared. Again, some sort of additional detail in this particular one. You can see here's our liquidation preference, a little bit more complicated than where we showed in that very simple term sheet from Cooley. Voting rights described, protective provisions where we sort of as investors have the ability to make sure that as long as we own a certain percentage of the company, we have the ability to sort of give we have to give our consent for any sort of major transactions. Anti-dilution, typically expanded upon pretty aggressively inside in the investor right agreements and the share purchase agreements. Redemption rights, reps and warranties are kind of a very standard legal thing. So you can see an actual term sheet is probably a little bit more complicated than, but a term sheet can be written on the back of a napkin. It can be written up on a 10-page document. It can be as complicated as your lawyer wants it to be, but typically simpler is better. And most of what we issue is very standard, very sort of vanilla, with sort of the classic industry National Venture Capital Association sort of templates for what a term sheet should look like. I'm trying to see is there anything else in here which is sort of important to you guys. Not really. I mean, your lawyer can your lawyer is really your best friend in all of these term sheet discussions. So let me get back to some of the questions. Okay, so Luca asked, does every C Corp have a board of directors? That's a great question. I imagine yes. I think it's a Delaware requirement that there is at least one director for a company. But how active that board is, whether you have any investors on there, totally up to you and your investor to negotiate. Linda asking, is a SAFE the same as convertible debt minus the debt? not quite. I'm probably the wrong person to ask from like a wonky sort of legal document perspective exactly what the differences are, but they're not exactly the same. Yeah, it's probably a good question for a lawyer to walk you through exactly what and I'm sure there's some great sort of Google things out there. I mean, I tell you, as we think about our order of preference, and this ties into the next question from Prashant as well, we would prefer to do an equity financed price round probably first, convertible debt as a second sort of option, with the caveat that there are situations where convertible debt actually makes a lot of sense, and we're very much a fan of it at those times. We probably will put SAFE at the bottom of that tier of like sort of available or possible financing options, just because as an investor, it doesn't give us quite the protection and the rights that we get from equity or convertible debt. It's yeah, but at the same time, if you're funding a company that's gone through Y Combinator or something else, like a SAFE is a very standard thing to do these days. We're totally okay doing that, but we would certainly, I think, prefer to do an equity priced round and then a convertible debt round with valuation. I mean, if you think about it, a convertible debt note with a valuation cap, you're essentially, we're essentially pricing the round. We're willing to pay up to that amount, so we're comfortable with that. It's sort of it is essentially a priced round, from not quite the same from a legal perspective, but as we think about it, we are sort of protected and have sort of the ability to at least understand what our ownership is likely to be given the amount of money we're putting in. Because as investors, we're typically most focused on our sort of, obviously our expectation is to become $1 billion company, but our percentage that we own is a pretty important part of the calculus as we think about the checks we write and sort of the rounds that we do. Okay, SB has asked, can the startup company registration be done first in California, later at time of the VC negotiations, converted to a Delaware company, or right away from the start, should it be a Delaware company? It's really up to you. You can start a company anywhere. Delaware is just a very standard, Delaware C Corp is a very standard sort of structure for venture investors to fund into. You don't have to convert it. I think we funded California entities before, but really, the majority of companies that we see are Delaware C Corps. So it's really maybe not that important, but it's probably more important if you're a legal entity from Austria, or you're like a French company. We may be more interested in seeing you flip to the US rather than, I think California versus Delaware is maybe less important. Rajesh, Class F shares, your thoughts? What does that mean? I have no idea what Class F shares means off the top of my head. Rajesh, maybe you want to give a bit more clarity on what you mean by Class F shares. My thoughts. Oh, okay. So Class F is this founder stock stuff. Okay. So like different classes of shares and sort of founders having sort of effective control through sort of, rates on voting rights and things like that. Again, I think it comes down to your position of strength in any negotiation. Like if you are, the hottest thing since sliced bread, and I, as an investor, I'm desperate to get into your company, I will compromise on a lot of the typical rights that I ask for. If you are, one of 100, I don't know, HR SaaS platforms trying to raise money in the Valley, I think your ability to negotiate those kind of terms is probably a lot more limited. So I think it's very situational. As an investor, I obviously want to be as protected and sort of as safely sort of ensconced in control as possible. And where that sort of balance lies versus your rights as an entrepreneur, that's always sort of case by case. I think any investor, unless you are Elon Musk or Mark Zuckerberg or somebody along those lines, and that's all like, post priori, right? It's easy to kind of look back and say, yes, they totally should have those kind of rights. I think it's probably hard to drive that if you're sort of a random founder coming knocking on doors in Silicon Valley. But absolutely ask the question. If you don't ask, you don't get. So I think that's totally a legit conversation to have. Sorry, Charles, I think you just answered Linda's question on the SAFE. Typically, the maturity date will be the thing, Linda. It's sort of an open-ended instrument. At least with a convertible note, I have some certainty that if you've not raised an equity round in 18 months or 2 years, I can get my money back. I can force you to convert me into equity at the price that we've agreed. So yeah, it's I think Charles said it very well. Typically, my preference is equity, convertible, safe. I think if you're an entrepreneur, it's probably safe, convertible equity, right? That's kind of the way you would like to see things. Yeah. Okay, one more question from Karim. Yeah, good lever, bad lever. We actually it didn't pop up in here, but typically that is a term that may appear in a term sheet. It's probably more likely to be in the definitive documents. I mean, it's a pretty standard clause to see in the definitive docs. But good lever, bad lever, essentially it's to do with your rights as a founder to your stock vesting if you leave on good terms versus a sort of an adverse event, right? Where there's a case of fraud or you get kicked out of the company. Typically a bad lever clause will claw back, all or some of your founder equity. So, that's obviously a downside scenario, but one that hopefully your lawyer, your counsel will help you sort of negotiate a reasonable sort of definitive doc term with your investor. Danuka asked about term sheets typically evolving from seed to Series A and B. Yeah, there is an evolution. We've talked very much about seed here. I didn't put together a Series A or Series B, but typically, as you get to later rounds, obviously the dollars and the valuation, all that stuff should be hopefully heading up and to the right, which is a good thing. As a founder, really it comes down to those terms around control and valuation, right? And what you're willing to compromise to get the right investors on board. I think that's sort of a sidebar conversation. If you think about it, capital is really a commodity, right? And what I do as an investor is essentially a service. Like I'm a service provider. My dollar is no better than anybody else's dollar from a pure sort of fungible currency perspective. Where you may be willing to sort of compromise around terms is to get the right investors onto your cap table. And you often see this with smart entrepreneurs, right? They're willing to dilute a little bit more or take a slightly, less aggressive position on things like control to get the right investor into the company. If you have the ability to take, $10 million from some random family office or $10 million from an investor who's specialized in the area you're working in, has bought multiple companies public, there's probably an economic value you can assign to having that investor on your cap table. And as you go to sort of Series A, Series B, Series C, really, unless it's a downside sort of scenario and it's sort of a punitive round, then there's, typically most investors are willing to sort of be pari passu with previous investors. There may be a desire for a Series B investor to sit at the top of the preference stack and sit above the A and above the seed and above everything else below that. But that is about the only thing that would change. It would be sort of the waterfall and the payout rights. Prashant has asked, does term sheet information taken into account into financial projections going into the subsequent rounds of funding? You're right, that question is a little bit unclear, but I can take a stab at what I think you mean. So you're saying, if I as an investor assign a value to your company based on your roadmap and sort of your 3-year projection for a P&L, absolutely. Like if you don't hit those targets and hit those numbers and continue to grow, your next financing round will not be influenced by what we did in the previous round. Every round of financing is a completely sort of de novo scenario, right? And if you have an amazing trajectory and you get a really high valuation in your seed round, but then you sort of level off and your sort of growth is much more measured as you head towards your A, you're not going to see the acceleration that you would expect from your A round, from your seed to your A round valuation. So I hope I've kind of got the gist of your question there, Prashant, but I may have missed it. So let me know if I've missed out on that.
You did. Thanks.
Okay.
Gareth.
Good. So that's been kind of a whirlwind of sort of information coming from me to you. It's been, we've got 3 minutes left. I'm not sure if anybody wants to jump in with any final questions. Otherwise, I think, I can sort of wrap up with just a couple of final thoughts, but it's really what I've been hammering home the whole time. The 2 things I would care about if I was you as an entrepreneur are really the levers around valuation and the levers around control. I think everything else, your lawyer can help you think through and be comfortable with. Most of the stuff that typically good investors put into their term sheets is very standard, very boilerplate, and the market sort of detects it. And as the market sort of drifts from being very entrepreneur sort of weighted to being more investor weighted. Some of these terms will change and become more normative, but typically the law firms who are working on these transactions see hundreds, thousands of transactions a year. So they have a very good sense of what market sort of norms are currently, and they can help you think through whether an investor is asking for something that's egregious or something that is very, very sort of standard right now for companies getting financed. But if I had to choose one of those two, it would be control. That would be what I would be most focused on as an entrepreneur. Getting the right investors on board, giving up a little bit in terms of dilution or valuation, I think that's a fine economic trade to make for the opportunity to own a slightly smaller piece of a much, much larger company, much, much larger pie. But the control piece, if you're not in control of your own destiny, that's where I would start getting concerned. Okay, I think we have 1 minute. So any final thoughts, Denyse?
No, that was such an excellent presentation, Gareth. My gosh, a great dive into term sheets, and I really do appreciate you also sharing the sample term sheet with everyone. So again, thank you so much for your time. This was really phenomenal. And to everyone who's joining us today, this has been recorded, and we will be sharing it out to the group after today's session. So. And we'd like to also thank our wonderful partners at Hopkins and Carley. So thank you, Chiara, as well. This program would not be possible without them. And thanks to everyone so much for joining, and want to remind you that on October 28th is our next program in our Startup and Venture Capital Club series. And we're going to focus on mergers and acquisitions. So thank you, and everybody have a great day. Bye.
Great, thanks everybody.
Thank you, bye. We're going to get on the next. Yes.